LVMH, the luxury giant, is down about 20% this year and about 35% from the all-time high. The richest European man is actively buying the dip. Should we? Let's find out. LVMH stands for Louis Vuitton Moët Hennessy. Louis Vuitton got founded in 1854. Moët and Chandon got founded in 1743. Hennessy got founded in 1765. In 1971, Hennessy and Moët merged together, and in 1987, that company merged with Louis Vuitton. This merge was influenced by Bernard Arnault. He was investor in Louis Vuitton and played a key part in the merge between the companies. In 1989, Bernard Arnault became CEO of LVMH, and with him as leader, the company acquired many different luxury companies. Some examples of these acquisitions are Dior, Fendi, and Givenchy. Bernard Arnault has proven to be a great capital allocator and an acquisition king. He doesn't mind a hostile takeover. This has given him the nickname the Wolf in Cashmere. More about him and his family later. LVMH operates over 5,000 stores in 70-plus countries, with products like the Louis Vuitton Speedy Bag, which takes up to 30 hours to make. The brand just screams craftsmanship. All these acquisitions have given LVMH a portfolio of 75 brands. You can see them in the picture. LVMH is the biggest luxury company of the world. Its market cap is around $300 billion. LVMH splits their revenue up in 6 segments, so let's address them one at a time. Fashion and leather goods. This is the largest and most profitable segment, including brands like Louis Vuitton, Christian Dior, and Fendi. This segment is 49% of revenue of LVMH, but 73% of profit of the company, calculated with full year 2023 numbers. This shows how high the margins on these goods are. Wines and spirits. Brands include Moët and Chandon, Dom Perignon, and Hennessy. This segment accounts for 8% of revenue of LVMH and 9% of profit of the company. Perfumes and cosmetics includes brands like Guerlain, Givenchy, and Fenty Beauty. This segment is 9% of revenue of LVMH and just 3% of profit of the company. Watches and jewelry includes Bulgari, Tiffany, and Tag Heuer. This segment is 13% of revenue of LVMH and 9% of profit of the company. Selective retailing, Sephora, and DFS Group are the major players in this segment. This segment is 21% of revenue of LVMH and just 6% of profit of the company. This is tough business, lower margins, more competition. We have seen competitors like Ulta really struggle hard. Other revenue. This segment is really small and actually gives a net loss. Examples of this are the French newspapers Les Echos and Le Parisien. In this graph, you can see the international revenue per continent. As you can see, Asia is a big part of the revenue. The main reason the company is struggling this year, LVMH continues to do acquisitions to strengthen its portfolio. In this graph, you can see the number of acquisitions per year. This graph doesn't make a difference for big or small acquisitions. LVMH's latest big acquisition was Tiffany & Co. in January 2021 for $15.8 billion. To give you an insight about how good they are in acquisitions, I'll dive deeper into this. It was considered an expensive acquisition. Once they bought Tiffany, they let the old CEO go and replaced him for Bernard's son. 1 year later, and Tiffany's profit had doubled. Another great acquisition was Bulgari in 2011. They bought it for 4 billion euros. The EBIT was around 100 million euros. So paying 40 times EBIT is very expensive, you'd say. 8 years later, and Bulgari was doing 500 million euros in EBT, making the deal sound a lot better. But Arnault has also failed some acquisitions. In the late 90s, LVMH tried to take over Gucci, but CEO Domenico De Sole fought back. He diluted shares and gave employees a stake, weakening LVMH's control. Kering then stepped in, securing Gucci. He also tried a takeover for Hermès. In 2010, LVMH secretly acquired 17% of Hermès, sparking outrage. Hermès fought back with legal battles, accusing LVMH of insider trading and stock manipulation. After years of conflict, LVMH agreed to divest its 23% stake in 2014, ending the intense rivalry. Hermès CEO Patrick Thomas angrily responded to LVMH's takeover attempt in 2010, saying, "If you want to seduce a beautiful woman, you don't start by raping her from behind." I think that says everything about this battle. You can divide the luxury sector in three segments: premium, luxury, and ultra-luxury. Premium. These products are high quality and stylish, but still affordable for many. They're more expensive than regular items, but not as exclusive as true luxury. Usually in this segment, it's about the volume of sales. Therefore, you see these goods at a sale often. Luxury. Luxury products are all about high craftsmanship, exclusivity, and heritage. These items are carefully made with rare materials and are hard to find. Owning luxury means status, offering more than just quality, but a sense of prestige. No discounts here. Ultra-luxury. This is the rarest and most expensive. These items are personalized, often one of a kind, and produced in very limited quantities. They represent the highest level of craftsmanship and are for those who seek the absolute best in quality and exclusivity. To give you an idea, here are some examples of companies per segment. Premium, Michael Kors, Coach, Hugo Boss. Luxury, LVMH, Chanel, L'Oreal. Ultra-luxury, Ferrari, Hermes, Brunello Cucinelli. LVMH has in 160 years never given a discount, but they're still below the names in ultra-luxury. I would love to own one of the names that is part of ultra-luxury. My struggle with it is their valuation. They grow about 10% a year and trade around a PE ratio of 50. Some part of LVMH's portfolio is ultra-luxury, but not all of it. This year you can see the difference between ultra-luxury and luxury very well. The luxury sector in Asia is experiencing a slowdown, while LVMH and others are seeing revenue flat to negative for the year. Those companies listed earlier see continued growth about 10%. That is because these companies have aspirational shoppers. I quote, "Aspirational customers occupy a unique space in the retail consumer market. They make purchasing decisions based on their desire to be a part of a particular lifestyle, usually associated with luxury brands." I think this is important to know the difference between these three before you invest in any luxury company. I personally would never invest in a company that consists mostly or even entirely of premium brands like Coach with ticker TPR or Capri Holdings with ticker CPRI. Not enough moat in those, in my opinion. Back to LVMH, what makes this company so strong, apart from their obviously strong portfolio, is their vertically integrated supply chain. LVMH owns its own tanneries, vineyards, and fragrance ingredient factories, giving it full control over the supply chain and quality. Not only on the production side, but also in sales side, LVMH trains its store staff in luxury etiquette and customer relations to ensure an exclusive experience. They own a lot of their real estate holdings, including prime spots like the Champs-Élysées in Paris. All of this leads to higher margins for the company. LVMH is decentralized, so every company does its own marketing and is free to run the business how they want, but I've also heard Arnault is often on the phone. LVMH burns unsold products like clothes and perfumes to maintain exclusivity and prevent oversupply, which could devalue a brand. Additionally, there can be tax benefits to this practice. In some cases, companies can write off destroyed inventory as a loss. Because LVMH is so diversified, they have different competitors in the different segments. Competitors for the most important segment, fashion and leather goods, are Kering, the mother company of Gucci, Saint Laurent, and others. Other competitors are Richemont and Chanel. In my opinion, LVMH has better brands than the competitors in luxury, with Louis Vuitton and Dior leaning more towards ultra-luxury. But as I said before, not every brand is on that level, and that's why I place them by luxury. It is the best company in the luxury segment, in my opinion. The story I told earlier about the acquisition of Tiffany and Bulgari shows how well this company is managed. Let's further dive in the management. Bernard Arnault is the key reason that LVMH is where it is today. It will be a miss when he retires. He currently is 75 years old. He said he will continue as CEO as long as he can, but eventually he needs to be succeeded. He actually used to be a civil engineer, not the match you'd expect, but I think it helped him building a huge conglomerate. Arnault is known for his long-term vision, pessimistic short-term, optimistic long-term. He's excellent in anything related to capital allocation. He has been the richest man in the world at multiple times, currently at fifth. He is just like all of us, a big fan of Warren Buffett. Bernard most likely wants to keep the company in the family since he has 5 kids. These are the potential successors: Delphine, Antoine, Alexandre, Frédéric, and Jean. Delphine, 49, is Executive VP of Louis Vuitton. Delphine has been with LVMH since 2001, overseeing brand development and strategy, playing an important role in LV's success. Antoine, 47, is CEO of Berluti and chairman of Loro Piana. Antoine focuses on expanding LVMH's luxury fashion presence and plays a role in brand communication and acquisitions. Alexander Arnault, 32, is CEO of Tiffany & Company. Alexander revitalized Tiffany, targeting younger audiences and enhancing its digital presence. This doubled the profit within a year, like I said earlier. Frederic Arnault, 29, is CEO of LVMH Watches, after being CEO of Tag Heuer. Jean Arnault, 26, is Director of Product and Communications at Louis Vuitton Watches. Like I said earlier, LVMH has their struggles this year, mostly due to the Asian demand. In this picture of their latest quarter, Q3, you can see the differences per group. The right-hand side is the organic revenue growth/shrinkage without external factors like currency. I believe these are short-term problems for the company, and that their growth will be back in line with the expected luxury growth, around 5 to 6% for the coming years. Given how strong some brands are, I believe some will be able to outperform this. LVMH has a fine-looking balance sheet. The company does have debt, about 30 billion euros, with results in net debt like EBITDA of around 1. Arnault doesn't like to leverage too much. As you can see, the net debt/EBITDA has been around 1 for the last 10 years. From 2016 to 2024, revenue grew from 37.6 billion to 86.1 billion euros, while net income rose from 4.1 billion in 2016 to 15.1 billion euros in 2023. Over the past decade, the company achieved a 10-year return on invested capital of 14%. As of 2023, the company maintains a gross margin of 68.5%, an operating margin of 25.6%, a net income margin of 16.3%, and a free cash flow margin of 15.8%. LVMH pays a dividend from their steady cash flows. At current pricing, it's about 2.2% yield. LVMH has also slowly brought the outstanding shares down in the last years from 504 million to 499 million. Although there is no program ongoing right now, the company expects a negative revenue growth of 2.5% compared to last year. This has resulted in a significant drop in the stock price. Then the question comes, is it time to pick up the shares? Bernard Arnault's answer to that question is yes. Here you can see his insider buys from the last weeks, and this is just 3 months. He has been buying actively even this week. You might think the quantity of these buys aren't big compared to his wealth, which is true. But given that he already has 48% of his net worth into this company, it just shows all he's got goes into the company. Huge skin in the game. The company trades around a PE ratio of 20, well below the mean PE, but obviously the growth is not there currently and is expected to be just shy of 5% next year, so I don't expect this company to back to the mean PE soon. Still, I think it's undervalued here. Can you expect insanely huge returns with this one? No, I don't think so, but I think you're buying a quality compounder on a good price, in my opinion. Can it beat the market on the long term? I believe so. With everything around you going up so quick, I think it's crucial to never forget downside risk. I think the risk reward on this one is very attractive, around 600 euros. Talking about risks. 1. An LVMH brand could fail if it loses exclusivity by becoming too common. Scandals, poor quality, or losing key ambassadors can hurt its image. The biggest risk, in my opinion. 2. Heavy dependence on Asia, especially China, adds risk as seen now with slowing demand. 3. Arnault leaving his role. I'm sure he will leave the company in a good state, but still, you never know what happens when the change actually happens. Opportunities. Chapter 1. LVMH brands can grow by focusing on rising markets like India, Africa, and other upcoming Asian countries. As people in these regions get wealthier, they will buy more luxury goods, giving LVMH a chance to expand beyond places like China. 2. General growth of luxury. 3. Digitalization could be an opportunity in the future, but I believe people want to be seen in the LVMH stores, so I'm not counting too much on it. Arnaud has been investing in AI this year, so that is something they are working on, though. Thanks for watching this video. I hope I was able to learn you something. I would appreciate a follow if you made it this far. If you feel like I missed something, feel free to add it down below. Which company should I do next? Let me know.